a very important conversation with Mahesh Patil, CIO of Aditya Birla Sun Life AMC. Remember, in the latest note that I see from them, Mahesh and team argue that why this might be a good time to invest. Mahesh, great having you. It's been a really long time. Thank you so much for joining in. And I ask this question to you. Good morning.
Good morning.
Is this the right time to wade into the waters when there is a fair degree of uncertainty around the growth of the mother market itself? If the US is going through a slowdown phase, if not a recession, could it pull markets across the world lower?
Yeah, good morning. So you're right. I think the Indian market started a correction much earlier, right? We saw when Trump came to power, we saw the US dollar rally and sell off amongst the emerging markets, and again our economy also started to slow down much earlier, whereas other economies across the world actually were starting to improve over there. So we have already seen a kind of a correction in our markets. If you look at from a peak, Nifty is down by around 15-16%. The mid cap index and the small cap will be down 20-25% or so. But more importantly, even the wider market, we've seen stocks are down. Like if you look at in the BSE 500, the stocks which are down by more than 30%, that number is almost 60%, which is kind of a level what we have seen only going higher during the global financial crisis and during the COVID crisis. So clearly the market is slightly oversold at this point in time. And some of the factors, which were hurting our growth, we think at the margin they are trying to kind of normalize. So be it on the monetary policy side, where the RBI is now trying to be more accommodative in terms of, they have already done a rate cut. They are trying to infuse liquidity into the wider market by doing OMO, the forex swaps, and ensure that the liquidity eases off. And also the restrictive measures which were there on the banks, those are slightly getting eased off a bit. So I think that should help. While the fiscal continues to consolidate, I think the focus on consumption, which is the need of the hour in terms of stimulating demand side, I think that should also start to kind of flow through in the next financial year. So I think that should help. All these factors we think will help a recovery in our market, at least on the economy side, and getting our growth back to around 6.5%. So that's the first premise, what we're seeing. And a follow-up of that would be in terms of the earnings growth, which had kind of got significantly downgraded in this fiscal year from around 16% to, probably will touch this year around 5% or so. Again, I think if growth comes back, domestic GDP growth, I think we should see that growth again coming back to around, say, 12-13% or so. So I think given that the most of the negatives are behind us from the domestic side, though I would argue that the recovery will be slightly slower, and the fact that the valuations, especially for the Nifty, is somewhere near the long-term average or slightly below that, which makes us saying that this is a good time to invest. Market can always undershoot on the downside. You're right, the global environment, especially in the US, right, where the data points in the last few weeks have turned a bit negative, and it's showing that there could be a slowdown over there, which could impact a few sectors which are export-oriented from here. But by and large, I think what we're seeing is that even the dollar strength, which was hurting the emerging market, that is starting to now weaken. And if US growth slows down, you could see policy rate cuts by the Fed. I think the chances of that are now gone up. And that could be good for risk assets. So I think given these factors, I would say that it's a reasonable time for long-term investors to buy into this market. Obviously, the markets are not going to go up in a hurry. You will see ups and downs over here. But clearly, there is some value which is emerging in a few stocks.
Okay, Mahesh. So therefore, do you say that it could well be that the screen is suggesting a value zone, go out and do your investments, but brace for maybe some more excesses on the downside as well. And I wonder if you believe that if there is more downside from here, is that an excess, or could it merely be, let's say, valuations reverting to mean?
So again, there are pockets in the market, where the valuations could still be higher, right? We've seen that. So and the fact that when the sentiment is negative, right, we've seen that sentiment and indicators have turned negatives, and even foreign selling. So that can lead to further downside over here. I'm not saying that this is the bottom, but what we're seeing is that the valuations are at a fair zone. The outlook in terms of growth is likely to improve from what we've seen in the last 6-9 months. And that's why I think for a long-term investors, I think this is the time to dip in. Obviously, we're not saying that you go and buy everything at one go. I think for the next 6 months or so, until I think the mid of this calendar year, I think the markets will remain kind of a range bound. I think earnings recovery also will take some time, probably say from the first quarter of next fiscal year when the base will start to look favorable. And that's how we need to spread out. And again, we're not saying that you go aggressive in the market in terms of increasing the risk or the beta. I think the focus will be, for example, for investors who are investing into mutual funds. We are saying that they should look at the large cap or the flexi cap space, not necessarily the mid and small cap, which is slightly more aggressive. I think where I think the market breadth, which is weakened, can continue to do so for some period of time, whether before it bottoms out. Also look at multi-asset allocation strategies. That would be a good way to invest, okay, for investors, because even fixed income and say gold as an hedge also looks reasonably good. So a multi-asset strategy, which includes equities, fixed income, REITs, gold, would also do well, because we think the return across asset classes on a risk-reward basis look to be reasonably okay. I mean, nothing is looking to give you any outsized return. So I think that's the approach is what we are advising investors to do at this point in time, because you never know where the bottom is, right? You can't time that. And I think in the next 3 months or 6 months would be a good time where any market dips can be an opportunity to further average and then build the portfolio for the next 3 to 5 years period.
Mahesh, hi, Tamanna here, and great to speak with you. I'm just wondering at this point, how are you looking at some core sectors which are seeing pain because what's happening globally? The big talk on whether America is going into a recession may not, and that conversation, tariffs, all of that changes on a day-to-day basis. One sector which seems consistently hit no matter what the news flow is IT. So if I ask you about the bucket of IT, pharmaceuticals, and then let me add an auto, how would you look at these spaces? Is this something that perhaps investors, viewers who are watching you right now should stay away from till the dust clears, or are there opportunities there?
Yeah, so I think all these three sectors you mentioned have been called out by Trump in terms of having reciprocal tariffs and increasing tariffs, okay, on some of these sectors. So I think clearly, I think the narrative has changed now in the last 1 month or so, especially on the U.S. growth outlook, right? Some of these Trump policies which are being played out in terms of imposing tariffs, and I think all these factors are likely to impact domestic growth, and we're seeing the data. The labor market is starting to weaken, and I think there are chances now of a downgrade to US GDP growth further from these levels. And I think that is likely to hurt. One is the tariffs. I think if you look at the IT sector, for example, in particular, I don't think the tariffs per se impact on the services side or on the visa side. We don't see much of a challenge. But if the US growth is likely to slow down and the probability of that has increased, then the recovery, what we are looking at next year in the IT sector, and we were fairly positive on the IT sector around, say, 3 months back or 6 months back, and we have been carrying that kind of an outlook. But I think in the context of the recent developments, I think one would want to wait out, because we are seeing the commentary is slightly starting to weaken. The discretionary spend, which is supposed to come back, I think that could get delayed. Also, dollar strength, okay, which was kind of supporting some of the exporters. I think that is also, I think the outlook there, okay, if US growth slows down and there are Fed rate cuts, then you could see the dollar kind of weakening, or rupee also, which was kind of depreciating. I think that could normalize. You can even see some appreciation over there. So all these factors need to be considered, and that's the reason why I think one would be a bit cautious. Having said that, I would say the IT sector still looks to be a fairly decent. I mean, the downgrades, what we are looking at in terms of growth, is probably 1 or 2 percentage points. It's not like a big difference. And if there is a correction and valuations normalize, I think the sector still looks to be reasonably good, because I think the whole trends towards AI and the spends toward digital over a medium to long term, that should continue. Pharma sector, I think clearly, I think the tariff cut, I think US, we are more positive on the domestic pharma names. I think the big benefit for the US generics plays into the margin improvement, what we saw this year, because of the prices came down, raw material price, and that's going to normalize. So, and with the imposition slightly uncertain in the US, domestic pharma is where I think is a place where one can safely hide is what I would say over there. And the auto sector also, I think, yeah, I mean, some of the exporters, auto ancillary companies will have to see how the tariffs play out over there. But clearly, if the US domestic growth is weakening and the auto sector is weak, I think you will see some kind of a concern there for auto exporters. On the domestic auto, though, I would say that we are going through a slightly weak phase. But if some impact of consumption, the discretionary consumption comes up, I think you could see some recovery there in the auto sector sometime in the second half of this, in the next fiscal year. So auto, and we've already seen a decent correction in the auto stocks, right? So I think that sector, especially the OE and the domestic OEMs, can be a good place to look at.
How are you feeling about financials right now, Mahesh? I mean, some regulatory headwinds there. Overall, structural issues like cost of deposit, etc., NIM pressures continue. But in the longer term, do you think it's a safer bet?
So financials, again, we've turned, positive on that since the beginning of this calendar year. Again, a couple of reasons. Okay, the lens, what we look at it is valuations first, okay, which were definitely reasonable compared to where the market was, but also ownership, right? We've seen a huge amount of selling in financials by the FIs in the last one year or 1.5 years. So ownership levels are low, and on the regulatory side, right? I mean, banks underperformed last year because there are a lot of regulatory headwinds which were there. A lot of these LDR ratios, the loan to deposit ratios, okay, which were increased. I think we've seen now some easing off on that front. I think the restrictive conditions which were there, I think, are starting to ease off. The deposit growth remains a challenge, but I think if the overall liquidity in the market improves and RBI is doing measures, I think we should see deposit growth slowly coming back. So I think banks, I think, should, while we might not see a very strong growth in the next fiscal year, because with rate cuts, margins will be under pressure, but I think that is there in the price. So at the margin, we see that the banks, especially the large private banks, I think where their growth should be slightly better than the overall industry growth. And we don't see any major challenge on asset quality. I think that could be a reasonably good trade where there is some under ownership, okay, especially from foreigners. Valuations are reasonable compared to the thing. And on the regulatory side, we're seeing things kind of easing off from the restrictive conditions which were there throughout of last calendar year.
All right, thank you for that, Mahesh Patil. Likes financials, IT might still continue to see some amount of pain. Great conversation there, Mahesh. Always a pleasure to speak with you. Thank you so much for your time with us here on NDTV Profit.